Hi everybody, it's Seth Martin. Welcome to the Middle Class Investor. Well, today on the 8th, June 8th, I've got the same rising wedge that we've been looking at on the S&P 500. And as you can see, this is the upper trend line of that rising wedge, and this is the lower trend line. And then this middle line here is kind of the midline of this pattern. And we talked about how, it goes from one side to the other, kind of oscillates back and forth. And as this narrows, it gets harder and harder and harder for participants in the market to make money. And this pattern will eventually resolve itself. And normally they resolve themselves to the downside. So we've had a completion, it looks like, of the pattern. Actually, technically, the pattern's not complete until it breaks out down this way. So if the market just continues to go up from here, then this isn't a rising wedge. Now, I know that sounds kind of crazy, but it's also very unlikely that will happen. So what we're going to look to do is we're going to look to see the market sell off back toward this lower trend line and probably break through this trend line to the downside. And then we'll look for it to retest the underside of this trend line. And depending on how it does that, we're going to throw up some caution flags possibly. So if you the interesting thing now is the Dow and the S&P look similar. So let me show you that. I can go look at the Dow, and it looks very similar now. The Dow, the interesting thing about the Dow is it had a rising wedge inside of its larger rising wedge. So this blue line here represents the smaller rising wedge, which is a little steeper, and it's broken out of that in what's called a throwover. And now this trend line here goes back to 2000, the year 2000. So if you connect the 2007 highs and the 2000 in the 2000 highs, this is the trend line you get going way back, and I can show you that real quick. See, here's the 2000 high right here, and here's the 2007 high, and then here we are at these highs. Let me go back to the closer one. So we had this little oval on the chart here last time we talked, and it's actually gone above that. So this throwover has been pretty strong. But the internals of the market underneath the surface, this would be the surface, the price action, are very, very weak. The breadth has been barely positive or negative all last week, all during this time, this run up right here. But there's a lot of bullishness. So the increase of the bullishness, I think Investors Intelligence said that the bullishness was a little over 62%, and it hasn't been that high since, you guessed it, 2007 and 2000. So basically what's happened is your bullishness has kind of outweighed the actual market action. So the actual participants in the market are very, very bullish, and that's overcompensating for the breadth of the market. The breadth is just how many different issues participate in the rally. So if we were to go look at all 500 stocks, the S&P 500, a bunch of them would not look like this. In fact, some of them would look down. So that's what breadth means. It just means how many companies are participating in the rally. And so now that the pattern is complete, it's time to be very, 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 very cautious. Extremely cautious. You don't want to get greedy here, because usually if these are in fact bearish wedges, the pattern's correct very quickly, and the start of the pattern is right back here on February 3rd. So the rule is, if this is a let's look at the Dow, because the Dow shows, you can see the bearish wedge that started within the bearish wedge So you got this blue wedge that's inside of the larger red wedge, and the start of that pattern is right here. Okay, so the rule is this corrects, and it will correct to just below this low, which is what is that? That's about 1,500 points on the Dow, and it usually happens pretty quick. You can probably count on at least half this time, maybe even less. So February to June is 5 months. You can count on probably this happening within the next 2 months. So I know that's pretty bad. That's nobody wants to hear that. Everybody wants the market to go up, which I do too, actually. But the best way to grow your money over time is to stay out of bear markets. The quote-unquote professionals will tell you that the best way to grow your money over time is to be diversified, because you never know what's going to go up. But the reality is, during bear markets, everything goes down. So the actually best way to grow your money over time is just to miss out on the bear market, or to benefit from it. But if you can miss out on it, you're way, way, way ahead of the crowd. And so that's what we're trying to do here with a 401k. And the reality is, with a 401k or an IRA, you really can't take advantage of a bear market anyway. All you can really do is miss it. So that's really what we're going to be focused on here. It's just how to get you off the train tracks when it comes barreling down the way. So there's not much to say here. We can go look at the bond market. The bond market has been doing pretty much exactly what we thought it would do. We can zoom out a little bit here and look at 5 years. So right now we're calling this a major low in the interest rate market, and the first run up from the major low. So if in fact this is the first major run up, and we'll know pretty soon, and then this is the first pullback from the first major run up off the bottom, then this next move will be very, very strong, and probably will take us well past 5% interest rate. So one of the old school ways of measuring that is use something called Fibonacci. Fibonacci was he was a mathematician from a long time ago, and he basically gave us our current number system. But if you do a Fibonacci extension, well, it's showing here that your interest rates are this should run up to here in this area, maybe even to here. So somewhere between 4 and 5.5% interest rates is what we should expect. Now, if you own bond funds in your 401k or your IRA, you are going to get killed if this actually happens. You're going to lose a lot of money. So hopefully you were using this little down move right here that we were watching, that we had our box here on the screen. Hopefully we're using this down move right here to get out of bond funds. And we've talked about that before, but bond funds are not like, they have bonds in them, but they don't trade in your 401k or IRA like bonds. What they do is it's a perpetual fund. So there's always money coming in, there's always money going out. There's no way for you to own a bond. So what they do is, if the total of the fund bond prices goes down 1%, then they deduct 1% from your account. Now, if you actually own bonds, you can actually hold the bond to maturity and get the face value out of the bond. But that's not the case in a bond fund. So in a rising interest rate environment, you do not want to be in bond funds. Okay, you will lose a lot of money, especially if this move back here that we looked at. Let's look at it again. If this is the bottom, okay, and I'm saying if because nobody really knows right now at this point. It looks like the bottom, but if it's the bottom, and this is the first move up off the bottom, and this is the correction after the first move, this next move will be very, very strong, and you lose a lot of money. So just be very, very cautious there. Don't buy into the fact that bonds are secure. Bonds are not secure, and certainly bond funds are even, that much worse in a rising interest rate environment. So if you look at the euro sold off really hard. The euro kind of made a top around here, around 140. Again, if this is the first move and we get a correction into this, maybe up into the 138 area, the next move in the euro will be very, very sharp. The NASDAQ continues to kind of lag the market. It didn't make new highs. This very much looks like this could be the first move down, and then this could be the correction back. If that's the case, the next move down from this high right here, the next move down this way will be very, very strong. That's really about it. If you would continue to tell your friends and family members about our site here, the YouTube site, Middle Class Investor. The market, I think, is going to get very, very interesting here in the week of the 9th, starting in the week of the 9th, and then on from there. And I'm going to do my best to keep you out of trouble. That's the mission of the site. So tell your friends and family about it. Forward them the link to the site. Ask them to subscribe. And I think to subscribe, though, you need a YouTube account. So you might have to go create a YouTube account and then subscribe. And if you're a Twitter fan, you can use Twitter to see when I post. Okay, because what I do is I go to Twitter and I do a tweet when I've posted a YouTube video. So that's about it. If you have any questions or comments, there's a place where you can comment on the blog if you don't like what I'm saying, or if you think I'm crazy, or if you have an argument in another direction, or whatever. I mean, we can open up a dialogue and we talk about it. You can have a chance to convince me. I can have a chance to convince you. So anyway, that's it for this week in the Middle Class Investor. Again, forward the link to your friends and family. You don't want to see anybody in your family lose a bunch of money again. And we just want to make sure that people stay safe. Now, obviously nobody's losing money just yet, but if this bearish wedge that we've been watching, if it comes to fruition, people are going to lose a lot of money. So just a word of caution there. All right, guys, until next week. Or I may come on sooner if we start to see some definite action in the market that requires immediate action. I may come on sooner, but if not, I'll see you next weekend. Thanks for joining the Middle Class Investor. Take care, everybody, and happy Father's Day next weekend.